Here at Trail and Tread, we strive for great performance and great products. Over the last 4 quarters, we've watched our company grow through the efforts that we've each contributed to it. And we're going to show you all of the progress that we've made here at our company. First, I'll introduce you to our team.
I'm Grady Witt, VP Business Analytics.
I'm Megan Apotheker, VP of Marketing.
I'm Rory Smith, VP of Manufacturing.
I'm Bailey Them, President.
And I'm Oliver Ledoux, VP of Accounting and Finance.
Now Rory is going to tell you more about the products that we offer.
Perfect. Thank you, Bailey. So we have 3 bike designs for you here today. So we have the City Cruise, Mountain Ibis, and Hog Rider. So if you look here at our bike designs, the City Cruise is geared towards more comfort and recreational riders, and it's priced around 10 or $1,050, whereas the Mountain Ibis is more for the rugged terrain and trail biking, and it is priced at $1,295. And the Hog Rider is designed for those air speed riders, which is priced at $1,050. So we originally chose within the first 3 quarters to just produce the City Cruise and Mountain Ibis because we just felt it was going to be the most profitable based on the locations we also chose and just how they aligned well with our marketing strategies as well. And then in quarter 4, we added on the Hog Rider, but it was not really the best decision for us based on where we had the stores located, which I'll also go into later into more detail. But these are really our different strategies on how we designed the bikes, as we wanted to have something just for people who really just enjoy that great recreational ride in the mountains as well as speed. And we designed our bikes based on that, with just prioritizing those needs based on that, and then marketed them based on our locations. So now the locations we chose, we have Rio de Janeiro, Amsterdam, and New York City. And as you can see at the bottom here, these are the setup and close costs for each of the locations. So we chose these locations because we felt based on based on the market, we thought these would be the best to open, and based on the bikes that we had designed as well and were prioritizing. So within these locations, those bikes would be doing the best in these locations, where some of the other locations didn't really have. It was prioritizing different aspects that we did not have within our bikes. And then, as you can see in the scorecard insight here, based on our production, so we were the best in the class with a 0.942, and we lowered our unit cost by 6%, and we enabled price flexibility. But one of our biggest weaknesses was our really human resource management. So we had a 0.739, which was the industry low, and we didn't really have a lot of training, which really caused morale dip and a turnover of 2 people. So that was really where our weaknesses lied in here, as well as our advertising. But we worked on within the next couple of quarters to fix that. And now I'm going to be passing it on over to Grady, who's going to be talking about the lessons learned.
Thanks, Rory.
Oh,
So first on the advertising side, in quarter 3, we made a mid-course pivot by cutting ad spend and Salesforce bonuses to free up funds for capacity expansion. While the intent was strategic, this move ended up hurting our market visibility and momentum. As a result, our market performance dropped to 0.245, which fell significantly behind our competitors, who were averaging between 0.364 and 0.370. Secondly, with our certificate of deposit strategy, we underinvested in quarter 2. That left us with fewer liquid funds to support growth initiatives, and ultimately it affected our overall sale trajectory. Moving forward, we plan to maintain more consistent advertising investments and ensure better timing and allocation to reserve funds to avoid similar setbacks. Next, I'm going to be passing it on to Oliver, who's going to be talking about our finances.
Thanks, Megan. Let's begin with a quarter-by-quarter snapshot of core financials. As you can see, cash rose from 102K in quarter 1 to 1.3 million or 1.4 million in quarter four, a six-fold increase that strengthens day-to-day liquidity. Total assets climbed from a million point zero eight to 3.36 million, reflecting strategic reinvestment and asset acquisition. A 3-month deposit after a deliberate Q2 drawdown, we rebuilt reserves to 400K by the end of the year, giving us a strong interest earning cushion, which is nice. And then finally, with gross profit, turned around from break even in quarter one to which was sorry, turned around from break even in quarter one to 1.7 million in quarter four, underscoring winding margins. Yeah, across every line, the trajectory is up, laying the groundwork for the broader performance you'll see next. So Bailey and I will shortly go over financial performance, market share performance, and manufacturing productivity. That said, with financial performance, zooming out, here's what those quartiles translate to at the macro level. Cumulative performance was up to 335.86. Growth score accelerated from 11.5 to 62.8 over the year. Capacity-led revenue surge sales up to 145% as we unlock production headroom. Cash balance goes from 102K to $1.3 million or $1.4 million, boosting liquidity as mentioned before in the snapshot. For the third, operating cash flow was negative at 124K, and it turned to positive, which is almost $1 million. Well, not quite $1 million. It was 863K swinging, which was a 304% swing. So meaning the core business now funds growth, which is awesome. And then finally, common stock went from 1.5 million to 2.5 million. This is a 67% increase, signaling investor confidence. All right, on the right, the line graph visualizes the momentum across the production segments or the product segments, each one trending sharply upward in quarter four. In short, disciplined cost control plus capacity expansion translates to robust, sustainable financial health. Now I'll be passing on to Bailey to go over market performance.
So as you can see, across all 4 quarters, we saw a high growth in our market share overall, as well as in quarter two, we saw the largest change in market share in the mountain segment, which for quarter three, we decided to make that our priority, and we saw our market share in that segment significantly increase after making that choice. Now, in quarter four, we did see some of the decisions that we make impact our overall market share, as well as our market share in both of our priority segments, but we'll be talking more on that later. And then for manufacturing productivity, we saw consistent growth in our ability to meet our or to accurately estimate our demand and to meet that demand. So over time, we saw capacity utilization go from 42% in quarter two to 88% in quarter three and 100% in quarter four, while our excess capacity costs significantly decreased during that same time, meaning that we were using up all of our capacity without any excess. And now I'm going to pass it off to Megan, to go over some of these decisions that impacted our market share.
Thank you, Bailey. So in quarter one, our team focused on deciding the different bike features to implement onto each bike. This helped us deliver high-quality bikes and build a strong customer base early on. The result of this decision was positive. Then in quarter two, we made a key strategic shift by changing our priority from recreation bikes to mountain bikes. This allowed us to better target a growing market segment, and it paid off. We saw an increase in overall market share, especially in the mountain category. Both decisions were successful and showed how well we adapted to customer needs and market trends. And then on the next slide, in quarter three, we made a conscious decision to underproduce in order to avoid unnecessary costs. This conservative approach helped us maximize efficiency, and the result was positive. We were able to utilize 100% of our operating capacity, which showed strong alignment between our product and demand. However, in quarter four, we took a different approach and chose to overproduce inventory by beginning to produce and sell the hog rider. Unfortunately, this led to a negative outcome. Demand didn't match our production levels, and we only utilized 76% of our operating capacity. That means we had idle resources, which likely contributed to wasted costs and inefficiencies. And then on the next slide, one of our main focuses was improving our gross margin through better process efficiencies. This wasn't just a financial move, it was the result of clear communication and alignment within our team. That focus led to a financial performance score of 62.8, which outpaced the industry average of 60. And then on the right side, another major decision was our early investment in production technology upgrades. That choice paid off because we reached the #1 rank in manufacturing productivity with a score of 0.942. And now Grady is going to be talking about the rest. Grady, you're muted.
As we look ahead, our strategy focuses on scaling what's working and tightening what can be improved. First, we'll boost our marketing spend in the mountain bike segment, where we already control 33% of the market. This is a high demand area, and increasing visibility here can push it into a dominant position. Second, we'll continue to refine our rebates and cost of goods sold to protect and grow our margins as volumes increase. Efficiency and pricing discipline will be key. Finally, preparing for a strong Q5 and Q6 by investing into more R&D and technology upgrades. With a surplus of cash, we're in a strong position to innovate and stay ahead of competitors who may be catching up. All right, next. Trail and Tread wrapped up the quarter with clear momentum. We drove nearly $3 million in revenue, delivered a net income of almost $800,000, and closed Q4 with over $1.3 million in cash on hand. We secured 22% of market share, providing that our focus on high margin growth, smart budgeting, and strategic marketing is working. Trail and Tread finished strong. Oh wait. Trail and Tread finished strong, driven by smart strategy, disciplined budgeting, and market focus, made data-backed decisions, and positioned the brand for long-term success. Thank you.